Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from ChartsandMarkets.com runs down the major markets. He takes a close look at gold, crude, and currencies. The Canuck buck is one of the worst performing currencies on the planet right now. InsideTrackTrading.com President Eric Hadik examines the cycles affecting climate, violence, currencies, and interest rates. We'll have charts to go along with his chat. VRTrader.com's Mark Leibovit jumps into the U.S. dollar, Bitcoin, inflation, and the manipulation of gold. He also has a special offer for you. Plus, at the end of the show, we'll have a company showcase update from RecycLiCo CEO Zarko Meseldzija. We'll talk to Ross Clark right after this.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money.
Pleasure to be with you, Jim.
Ross, how did the markets shake out the week?
Let's see, another quiet one. They try and break the trading range open for a week or so, as they did 2 weeks ago, and then you get into a quiet one this week. It's just more backing and filling, and sort of reminiscence of decades gone by when I remember we had big runs, and then you would sit around for 6 months to a year just of thrashing, and that's basically what we've got happening now. If you look at the broad indices like the Dow or the S&P and the Dow, it just stuck here. The S&P, for all that we've got half a dozen of these big name stocks, high capitalization items, the Microsofts and the Nvidias and the Facebooks, which we now call Meta, racing along on the upside. They are not even capable of pulling the S&P back more than 50% of what it's lost since the highs of January of a year ago. So this is still, it's a market that's very, very narrowly based, and the more that you see this, the more that the divergences with things like the advanced decline line really do start to come into play. And then we know what season it is. It's sell in May. Not that markets fall out of bed, but then you at least are into that unfavorable period where surprises tend to be more to the downside than to the upside. So here we are. As I say, not much happening in the S&P and the Dow, but the NASDAQ, which has been just clearly one of the best performers, is now at the point where it's finally into a bit of an overbought territory here. So if that one's now ripe for a correction, I would suspect that anything else there, as far as those markets are concerned, would be vulnerable as well.
What's going on with gold?
Well, gold, here we've got this peak up at this 2020 or 2050 level that we've been harping against for the last couple of years, and unless it can get through there, there's really no catalyst out there. Seasonally, we are into a period here now where the precious metals tend to settle off to the downside into the latter part of the spring, sort of into June, and you start to look for a corrective low at that point. The difficulty we're having getting through the all-time highs at this point, very much like what we saw back in 2009, trying to get through the $1,000 level, and back in the 1970s, trying to get through $200. It's just you put your head up against this overhead resistance. You make multiple attempts at it. This one looks as though it's still in need of a a decent correction, maybe a $50 to $100 correction from where we are right now. And when you take a look at what's happening to the silver market, I mean, it's had a pretty disastrous week here right now. We've had silver drop from, $26 down to $24 in a span of about 4 days. So pretty steep correction in there. We're sitting around 24 on silver, probably looking at support closer to the $21 to $22 range. And, if it can get down and nicely oversold in this next couple of months, that could be an interesting spot to take a look at.
What's going on with crude?
Crude, we had the appropriate rally off that $64 low. We rallied up to 74, which is where we at this point have been looking for the lower resistance level to come in. That numbers in the 80s are not applicable right now. That 74 was a good target. We got up to 73 3/4. We closed off the week on the weaker side of things, back down around $70. Ideally, this one is set up to go down and test or take out that $64 number again before basing out. And I think you can be looking for a multi-month rally, but that's only after we've had a bigger shakeout than we've seen right now. So not looking for anything special there on the upside. And when you look at gold and you look at the crude oil and then take a look at what's happening on the currencies, this U.S. dollar has put in a nice little base here over the last couple of months. Here we are. The index is at the best level in 5 weeks. It's got this nice rounding bottom in here. And so with that, it just puts pressure on these other items that are priced in U.S. dollars. And thinking of currencies, looking out here, I was looking at the Canadian dollar. And, for all that we think it's been weak against the U.S. dollar, it's about the weakest major currency in the planet these days. It's down about, in the last year and a half, it's down 14% against the euro, 13% against the yen. It's 25% against the Mexican peso, and that economy down there is just rolling. Had lunch with a few people the other day who spend 6 months less a day down in the state in Mexico, and they say things are just booming down there. So here we are. Canadian dollar just cannot get anything going on the upside, and if this U.S. dollar is going to firm up a little bit in here, who knows how far down the Canadian dollar is going to go at this point.
Ross, thank you so much for the update.
Always nice to be with you, Jim.
Our guest has been Ross Clark from ChartsandMarkets.com. Find him on Twitter at ChartsByRoss. Coming up, Eric Hadik next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Well, thanks for having me back, Jim.
Eric, you talk a lot about cycles. Can you define that term and describe how you use cycles in your financial analysis?
Yeah, that's always a good place to start. And in fact, sometimes before even getting into what I define cycles as, at least in my work, I'll start out by telling readers or listeners what cycles are not. And I try to make it clear that cycles are not perfect. They're not an investment or trading strategy in and of themselves, even though they lay the groundwork for that. They're not a standalone tool. They're not the Holy Grail. Instead, they're more of a foundation on which a better understanding of the markets and of our world can be based. getting into a little more specific definition of what I view cycles as, since the term can be used and understood differently by different people, I would use the term cycles as being synonymous with a timing indicator. And sometimes that describes intervals, consistent and recurring intervals of time between certain events, certain similar events, certain rhyming events. Cycles are also the full circuit or gamut of things that occur between those intervals. So between a specific high in, say, a certain market or economic situation, then the whole circuit of things that go on between those two peaks, that's also a definition of cycles. But it really is, to me, it's just identifying these timing indicators that help lay the groundwork and build the foundation on when and how and where to expect different events, to enter and exit markets. It's a backdrop, or cycles are viewed as a backdrop that really identifies when the timing is right for certain events to occur.
What would you say are the most reliable longer-term cycles, and why do you think they work?
That's a good question. There are, when you talk about recurring or rhyming events, you'll hear people say, history rhymes, it doesn't repeat. Things do recur on a pretty specific interval or basis, but not exact things. In fact, often those events are disguised enough that the masses don't even recognize that you've got this recurring periodicity of events that are related to past events and even help portend future events. And really before that, there's three primary longer-term cycles that in my 4 decades or so of studying cycles, I have seen to be the most consistent and reliable in timing things like geopolitical shifts, monetary trends. I've even discussed currency wars that keep coming at a regular interval, climate shifts and trends. All last year I was talking about how a 40-year cycle of drought, a whole recurring interval and circuit of drought to deluge cycles happens on a very consistent 40-year cycle, and why I was convinced that California and the West Coast was going to be inundated with precipitation this past winter and this coming winter. And so it's those types of things. But the three most consistent cycles that I've seen are all directly related to the magnetic interaction between the sun and the earth. And I'm talking about something scientific, not something esoteric or mystical. This is proven, documented, observed, measured science. But those three cycles are the approximate 11-year, they kind of average it out to 11.2-year sunspot cycle. And that's the approximate time between peaks and between troughs in the sunspot cycle, when you get the most, when you get the least sunspots. So that's one of them, which is very directly related to the sun, and because those sunspots, those explosions on the sun project out plasma, project out these CMEs, these coronal mass ejections, of electromagnetically charged particles. They have a very direct correlation to some of those, the impacts of electromagnetic forces and fields on our world and even on psychology. But the second one of those cycles is a 17-year cycle that I talked about and documented 20 years ago, and I really was highlighting it leading into the 2007 peak in the stock market, and showing how every 17 years you had a very consistent peak. You had even some geopolitical upheaval, but on a on that 17-year basis for 150 years or more, there had been stock market peaks and then at least 15 to 20% sell-offs, and every other one of those 17-year cycles, so a 34-year cycle, you had 35 to 50% sell-offs. 2007 fulfilled that perfectly. In fact, 2024 is right on the horizon, and that's the next phase of this 17-year cycle, but that's another discussion. But this 17-year cycle has been documented as governing what they call the two-and-away magnetic interaction between the sun and the earth. So it's another one that directly impacts the magnetic forces between the sun and the earth. And the third one is a 40-year cycle that you can see documented all through history. Even if you treated the Bible just as a historical book, you could see the dozens of references to, it's also 40-day, but 40-year cycles. You could see them all through our modern world, and I've documented over the last couple hundred years very consistent 40-year cycles in currency wars, in geopolitical and war cycles, and as I said a few minutes ago, in drought and floods. And that cycle governs, they really only discovered this in the last 10 or so years, what they call the Great Conveyor Belt of the Sun, and it has to do with the explosions on the surface of the sun and how the movement and the polarity of sun's surface comes along, sweeps these down. It's above my pay grade to get into the real detailed analysis of that, but the bottom line is all three of those cycles are very directly related to magnetic interaction between the sun and earth, and we being electromagnetic beings, that's why doctors use scans and tests like MRIs, magnetic resonance, EKGs, EEGs. They all have to do with electromagnetic pulses, waves. Every cell has your protons, neutrons, and electrons, different electrically charged particles within the nucleus. So everything in our world is electromagnetivity on one form or another, and those cycles have shown to be very consistent in identifying times when you see extremes in events on Earth, and when they come together, when you have the synergy, which is really what I focus on most in all of my work, that idea that a cord of three strands is not quickly torn apart, as the king said in Proverbs. That idea of synergy is the most powerful when you get these cycles all coming together, and that's one of the things I've talked about in recent years.
For so many years, you described generational cycles that you expected to shift in 2021, 2022. Can you refresh our listeners' memories on why you believe that and what it means for the coming years?
Yeah, I kind of alluded to a little bit of that, both the drought to deluge cycles that I talked about for so many years, and why I explained that from 2017 to 2021, I expected to see a final kind of the parabolic move in drought, in warming, another spike in warming, and that then after 2021, we would see a shift in precipitation and climate in different regions. This was something a little bit more regional that I was identifying and monitoring, that had more of an effect on North America and even the west coast of North America. But when you consider the amount of produce and crops that are raised in California for the entire world, you can see where that can have an effect on a lot of commodities and commodity prices moving forward. But that was one of those cycles. I know I talked with you for several years about this whole idea of currency wars that you saw recurring on a very consistent 40-year basis. And the last one kind of culminated in 2016 to 2021. I was looking for a surge in gold during that time frame. Once it became clear that digital currency, cryptocurrency was also in that whole currency battle. That was another one looking for a surge into 2021. And so these currency wars were recurring, but there were also bigger cycles and human civilizational cycles that were both culminating and transitioning in 2021, 2022, and starting what I believe is an entirely new cycle on several of these levels. One of them that I recall you asking me about for several years leading into 2021 was the 80-year cycle of war, that I had written about throughout the 2010s. And so that's two of your 40-year cycles, kind of like that 34-year cycle is a pair of 17-year cycles. The 80-year cycle is a pair of the 40-year cycles where you get more intense types of events. And I traced that back for a couple hundred years in America, but when you consider Europe, England, and America, that 80-year cycle dates back to at least the 1200s, and I documented each of the recurrences that were telling me to look for a new surge or uptick in war from late 2021 to late 2025. And that's right when we had the Ukraine invasion take hold, late 2021 and into early 2022. And I think there still is more to that war cycle to unfold in the coming years. But it was, again, a lot of synergy that I talked about, and in the markets too. All of this has a market application. I'll talk about some of these bigger, broader cycles to give my readers an idea of why I think you could be having major moves, like the 4 to 5 year bull market I was expecting in gold from 2016 to late 2020. There were reasons for that. There were these longer term cycles, but then you also have to boil it down to specific indicators to tell you when to get in or not to get in, what your risk levels are, confirmations of those trends. It's not just taking a big generational cycle and saying, okay, buy this or sell that. Those are just a backdrop. But there's a lot more to it too. I won't go into it all right now, but why I thought that 2022 was going to start an entirely new cycle, and I've kind of detailed why I think the first 7 years of that new cycle are going to hold a lot of surprises in store for the markets, for the geopolitical spectrum, and a lot of other things in our world.
Are there any specific cycles in the next 1 to 2 years that should really be watched carefully?
Well, one of them I did mention there, and that's that 17-year cycle, which has both had an impact on battles, often in the Middle East, and also on stock market sell-offs. And so, one thing wouldn't surprise me is if we still see some more selling in stocks here, but then sometime in the latter part of this year, early part of next year, perhaps get a decent rally or rebound, and then another top, higher or lower, is yet to be determined, but another top is set with that very consistent 17-year cycle. And again, you can go back. You can see obviously what happened in 2007, 2008. In 1990 to 91, you had market had rallied, and then the Iraq-Kuwaiti war set in, and you had about a 25% hit in the stock market. 17 years before that was 1973, 74, where everything from Vietnam to the Nixon resignation to the Yom Kippur War in the Middle East and the first oil embargo all hit the market, and you saw almost a 50% drop during that phase. 17 years earlier, that in 56, you had something similar. And you go back, and this is just a very consistent cycle. And so I'm definitely going to be watching that over the next year or two. But there's also the the starting phases of some of these other things that I've talked about, even where something like gold and silver is concerned. I explained why late 2022 should be a secondary low in gold and silver, and why they should see a 1 to 2 year bull market from there. The first phase of that was expected to last into the opening days of May, and I still contend that early May is going to be a multi-week, perhaps multi-month top in gold and silver, but I expect that to be a top in a sequence of ascending highs over time. But in between, you can get several months of volatile, though more sideways trading that can frustrate traders and often have them lose sight of the bigger trends and the bigger moves that are unfolding. And so there are a couple of specific cycles that I think are going to really manifest themselves over the next 6 to 12 months and 1 to 2 years. But there's some others, too, that I've just started to detail and discuss in my Inside Track newsletter and weekly relay periodical that I'll be going more in detail to. But I think that's a couple good ones that your listeners can certainly have on their radar and be looking for corroborating evidence to validate those cycles.
Perhaps 3 things people are really interested in right now: gold, crude, and interest rates.
I agree. And interest rates, that's one of the other ones that I've been detailing. There has been such a consistent 4-year cycle in bonds, and it helped pinpoint, and this was published for months, actually a year and a half in advance, why June, July 2020 should mark a major top in bonds. And that was exactly 4 years from the peak in July 2016, which was exactly 4 years from the peak in July 2012. And the next phase of that, when I think you'll see a lower high in bonds, is around July 2024. And when you have a cycle like that, approximately 4 years, one of the most common sequences for a market to trace out between those highs, since you have to have both a sell-off and a rally, or incline and decline between cycle lows. It takes both of those trends to make up a cycle. So with a 4-year cycle like that, what you will often get is a market will decline for 2/3 of that cycle. And one of the things that does, it sets the market up for a 50% rebound or retracement in time. So if you've gone one direction 2/3, 50% of that is 1/3. So if you retrace or correct go the opposite direction for 50% of the original move, you've now completed one cycle. Let me put that into specific months the way I did for bonds. If you're looking at a 48-month cycle between highs, one of the most common things for a market to do, especially when it's a trend that's a major shift. If you're in an accelerated trend and you've seen a sequence of lower highs and then you get a much bigger, more accelerated drop, that's different. But at this phase in cycles, you'll see this. So that 48-month cycle between highs, if bonds dropped for 32 months following that peak, then the ideal scenario is that they rebound for 16 months. 32-month decline, 16-month rebound. It's a 50% retracement or a rebound in time. In order for that to be the case, bonds needed to sell off into March of 2023, which is exactly when they bottomed. And they've been putting in a bottom ever since then. And I think that on balance, and that's a key thing there that I'll get back to in a second, on balance, I think that bonds will move higher into July of 2024. Let me define that so there's not... often when I talk about cycles, people assume because there's a cycle low, that means that a market is just going to shoot up to the moon from that low. That is not what it means. in theory, you could have bonds going sideways for the next year, and then in the final couple months of that 16-month period, they rally, and that becomes a lower high on a cycle basis, 4 years from the July 2020 peak. Again, I'm saying that in theory for kind of explanatory reasons, but it doesn't mean that the market goes straight up into that next cycle high. What it means is that two things. The March 2023 low should hold. There shouldn't be any lower lows than that. It may be retested, but that should hold through that 16-month period. And then as you come into July 2024, bonds should be setting the highest levels that they've reached during that 16 months, whether that is 10 basis points from the March 2023 low or 40 basis points from the March 2023 low. Doesn't matter. It's just from the definition of cycles and from this particular 4-year cycle, that's what it's showing. And there's a lot of other specific indicators that then allow you to hone that analysis. There's a lot more to it. It's just a starting point. But that kind of tells me what a lot of economists are already kind of expecting and hinting at, that we're ending the interest rate hiking cycle, although this time frame was identified 2 years ago as far as that March 2023 time for bonds to bottom, long before your economists knew when the rate hiking sequence was likely to end. Cycles were already pinpointing when it was most likely. And you'll probably see at some point latter part of this year, early part of 2024, some interest rate cuts, or at least the perception or expectation for those interest rate cuts. That's the other thing. The markets operate on expectations and perception, not necessarily on reality. And so bonds, I do think, are going to, that they've put in a bottom and they're going to, over time, edge higher. But there's specific times when I expect intervening 2 to 3 month highs and lows throughout that period of time. So I do think that interest rates are in a peaking, topping phase, and I think that is going to have an impact on some things, even like gold and silver. And late last year, when I was describing the cycle lows that were coming into play in late 2022 in gold and silver, I was also explaining why, from a broader standpoint, bigger cycle perspective, that they were entering what I called the sweet spot of an inflationary cycle. And what I meant by that was when you've got your inflationary fears like we had for the last year or so, and you've got these fears of interest rates being hiked, that keeps a ceiling, that keeps a lid on gold and silver. Higher interest rates are not something that's good for holding gold and silver. And so you get to this point within an inflationary cycle where we are now, where inflation's still there. It's moderating a little bit, it's, pulling back a little bit, but it's still very much there, which is a positive for gold and silver. But now you're removing that fear of higher interest rates. So all of a sudden, the thing that is keeping a lid on gold and silver rallying as an inflationary tool, which is not their only reason for rallying and not their only positive influence, but it's one that's often recognized. You've removed that big impediment, and you've now kind of opened up the lane for gold and silver to start moving progressively higher on different factors. And another one of those factors, I think, is going to be the dollar, but also looking at that later this year into early next year, where right now I think the dollar is trying to bottom and could see a decent rebound, but later this year and early next year, I think the dollar is going to start showing that it's at a major top and is entering probably a multi-year bear market after that. And that's another thing that could really be beneficial for gold and silver. So you've got that combination of factors either already taking place or becoming more likely on the horizon that I think are going to be very positive for gold and silver over a specific period of time.
Eric, any cycles that might be affecting commodities like copper or wheat?
Right now, I think they're in a bit of a deflationary 3 to 6 month, 6 to 12 month cycle. There is a pretty consistent 5-month cycle in copper that I discussed back in reading into January, why I thought we would see a 3 to 6 month, maybe 6 to 12 month peak in copper. And it has continued to hold below the peak it set in January. And ever since then, there's been specific downside price targets for that move. And I think that copper is entering this time frame here in the early part of May, where I think it could have a sharper sell-off leading into when I think we'll see a pretty important low over the coming weeks. Wheat is something that I'm looking at early June for a potential bottom, and along with that, corn and soybeans had given some very convincing sell signals back in March, and my outlook ever since then has been similar, that those grains would see some sharp sell-offs into late May, potentially stretching into June. And some of that even fits with that drought and flood cycles that I talked about. That, you know, the rains certainly have an initial bearish effect on grains. The perception that drought is at least not an immediate concern for the coming year or two, but there's other complications of too much rain, flooding, topsoil erosion that down the line could turn around and have a bullish effect on them. But right now, from a psychological effect, everything was showing me that grains should head sharply lower from March into June. But then, depending on where we've hit at that point, I think it could be getting ready for a pretty significant bottom, particularly in wheat.
You pointed out a specific cycle that seems to affect Bitcoin. Can you maybe tell us about that?
There's been a couple of obviously Bitcoin doesn't have that long of a history, so cycles within it are limited. But that whole idea of currency battles, and when I explained that and defined that 6, 7, 8 years ago, and ever since then, I talk about the ongoing battle between hard currency and fiat currency, which historically is between gold and silver, sometimes other metals, and paper currency, debt-backed currency. This last phase, obviously, you had digital currency, kind of make it a three-way battle there during the culmination of that latest 40-year cycle, which was completing in 2016 to 2021, and so Bitcoin was just along with gold surging into late 2021. It actually had, in its limited history, had already been showing signs of a 4-year cycle, which was one of the multiple things I wrote about in 2021, why I thought that Bitcoin was ready for a major top and a bubble bursting. But much like some of your other bubbles over the last few decades, and one in particular is tech stocks back in the early 2000s. You had that the dot-com bubble and burst. That didn't mean that tech stocks were suddenly going to just fade away and disappear, but it meant they had gotten so overblown that they needed a huge correction to then start developing a more manageable and more realistic trend. Many of those bubbles and bubble burstings see a market lose about 75% of its peak value, which is what I was looking for in Bitcoin. And that put a target down around 16,000, 17,000 as a bubble bursting bottom, if you will. And that is where Bitcoin got down to, and Ether had certain similar objectives and support levels, and they came into a time frame in the second half of 2022 when I thought we were far more likely to see a pretty significant bottom. So from a broad basis, I think you've set multi-year top and a multi-year bottom, and now it's time for cryptocurrency, digital currency to start to build a base for a new trend. And that's also, if you compare it to something like the tech.com bubble and bust of 20 plus years ago, that's when some of your original leaders in the first bubble, they may fade from the forefront or even from existence, but then a new generation takes over and starts to drive that next trend, that next cycle forward. And so I think that's what you're probably going to see in the coming years. But for right now, there's some short-term and intermediate cycles in Bitcoin that are telling me we could see a quick sell-off to about 25,000, and if that level holds, there's some argument for another pretty solid rally from there that I'm just describing to my readers now and what the targets for that would be.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Eric, how can people sign up and subscribe to your service?
Well, you pretty much just listed the ideal location. InsideTrackTrading.com is where people can go and access a lot of our information, examples, sample reports, and that's inside with the extra I in the middle. So it's INSIIDE, tracktrading.com. And they can also contact us for more information through the website.
Eric, thanks again.
Thank you, Jim.
Coming up, Mark Leibovit, next on This Week in Money.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money, Mark.
Thanks for having me, Jim. Appreciate it.
Mark, do you have a special offer for our listeners?
So let's do it. I just want to disclose up front that I'm not a financial advisor, nor do I provide financial advice, but I do publish VRTrader.com and have been doing in one form or another since 1979. So meanwhile, if you go to VRTrader.com, which is a shortcut to Leibovit VR newsletters, that's really the product itself with a bunch of letters you can choose from metals and resources, all the way to market timing, even our crypto blockchain letter. A lot of choices there depending on what markets you're interested in. But there is a discount offer. It's 50% off, and the promo code is 2022 half off, just as it sounds, 2022 HALFOFF, and just enter that in the promo code. And that's for any subscription or time frame that you choose, or even a bunch of them if you'd like to do a few, of course.
Mark, the market's ending the week on a down note for the second week in a row. Are you concerned?
Well, I've been concerned for a while. It depends, obviously, what you're invested in. For those who were invested in the FANG stock, which, have been leading the market here up about, 20%, and that includes, Meta and NVIDIA and Apple Computer and Tesla and all the hot names. There's only about 5 or 6 of them, and they comprise most of the increase we've seen in the S&P. If you're in those, you're happy, and probably, I guess you want to stick with the winners that seem to continue to attract the buyers. It's a handful of stocks, but I'm concerned because our models indicated a lot of volatility in this time frame. That we could get a summer rally. We could see we have this debt ceiling issue here in the U.S. and it could come down to the wire, and there could be a bit of a panic back in 2011 when we had a similar event. I think there was a shakeout of about 19% in the indexes during that period. So it depends how nasty it gets, whether they compromise or not, whether the U.S. defaults on its debt. And, Janet Yellen is saying our deadline is June 1st. So I'm saying it could stretch out to August. I mean, this is serious stuff, and if that really happens, it can get pretty nasty if U.S. actually defaulted. I don't think it will, but you just never know. There's some pretty stubborn people out there trying to make a point about what they believe the spending of the country should be. It's way overdone. I mean, it's actually, when you think about it, I mean, even if you went ahead and increased the limit, which everybody wants, and it just constantly goes up. I read somewhere it's been increased like 85 times. I mean, and there may have been only a couple instances that it actually was cut back. So we're just spending ourselves into oblivion, and ultimately there's a price for that. And then we have the deal with inflation. The truth is that, even with the Fed raising rates, we're still under the inflation rate, which is higher than the 5% I think we're at now on the Fed rate, which means it could still go higher. And then there's this whole other issue, about the Fed and the banks cutting back on credit, and which really is the way it worked back with Paul Volcker back in the around 1980, where, you were restricted in your ability to borrow, or it became more and more difficult, and that really put a lid on the inflation, and we're starting to see some signs of that. And we're not even talking about geopolitical stuff. I mean, what's going on in China and Taiwan and Ukraine and Israel, Iran and North Korea. And I mean, just, there's a lot of stuff out there, but, the market, if you're just looking at the FANG stocks, the high-tech names that I mentioned a few moments ago, you could argue the market was climbing a wall of worry, which is Joe Granville's old expression. And the more the news is out there, the worse it is, and the market is not collapsing. It just, again, it's a contrary thinking about what markets are really all about. They go up when everybody's worried, when it's not supposed to, and they go down when the earnings and everything is positive, and it shouldn't go down. And it's just the contrary nature of the marketplace. So, just the analysis that I'm doing, I just think, there's some downside risk here, but, I suppose they could, some of the cycle stuff is saying that, you can get a rally and, it'll look good for the short term, and, we can, surprise everyone just because everything is so bearish out there in terms of the fundamental news. But, we do have the presidential 4-year cycle, which again is theoretical stuff. Nothing's 100%, but some type of low is due, between September and next fall, the first quarter, I was going to say, of 2024, and you got the election, and that tends to be a low point, and then we rally. And then we had the January barometer, Jim. Remember the beginning of the year, the January barometer was created by Yale Hirsch back in the 1970s, and it says, so goes the year as so goes January, or the first 5 days of January, and that was positive. So in a sense, it's been right because of the FANG, high-tech stocks have kept the indexes up, even though the majority of stocks, like in the Russell 2000 and Dow Transports and others, haven't been doing as well. That indicator so far has worked, and if we get more of a shake here, we could still end up net higher at the end of the year. And you can say, well, the January barometer was right, even though there was a lot of volatility and bad news, and different markets are moving in different directions. The net of the S&P was up, and so if you withstood the the volatility, or just turned off the TV and didn't look at anything for the whole year, you might be up a couple percentage points for having done nothing. But that's not the way, I look at the markets. I'm more active than that. So anyway, I have a long-winded response. I mean, there's a lot of bad news, but the market seems to be so far ignoring it. If the market, if the country goes into default, the U.S. Default happens, and I guess there could be a shakeout. It's based on recent history. And, of course, geopolitical stuff, something could happen anywhere in the world. We're not even talking geocosmic stuff, in terms of solar flares or earthquake like we saw in Turkey and all kinds of other crazy stuff. Or hurricane season is coming up, and what that might do to the markets and to oil and to a lot of other things. So this is what makes the business fun. I mean, just a lot of volatility, a lot of things going a lot of different directions. Like a big name stock like Disney, for example, got nailed the last couple of days. I mean, down like 10%, which is a blue chip stock that everybody owns, that surprised everybody. I mean, there's always fun, surprising stuff happening out there. And then, with all this bad news, look at all the bad news we've talked about. Gold rallied for a while, but seems to have hit a brick wall and was unable to break through recently, though it got to a new high intraday. It really didn't stay there in terms of U.S. dollars. That was so surprising people that some of the gold shares were underperforming here in recent days when, if the U.S. is going to default on its debt, shouldn't the gold be $10,000 an ounce or something? So that hasn't happened. So it's a lot of fun and interesting stuff. But yes, I'm a little cautious here, but I recognize, I hate to use the word manipulation, but obviously, you got some stocks holding the market up and giving the illusion of a lot of strength, and that could persist. There's a entity I keep referring to. Most people don't think it's real or it does anything, which I don't think is true. It's called the Plunge Protection Team. It was enacted by Ronald Reagan in an executive order back in 1988 called the Working Group of Financial Markets, and that allows the feds to come in there and buy the market. Now, Japan does this almost completely. I think that Japan owns about 80% of their ETFs and stocks supporting the market in Japan, and of course Japan's got a zero interest rate still, which is a whole other discussion. And their stocks seem to be doing pretty good now. The indexes are moving higher. But going back to the Plunge Protection Team, I mean, it's, government's in there. We talk about the Fed and it's raising rates, and will it contract the M2 money supply or expand the money supply? But they don't talk about the fact that the Fed's in there, has the ability or through the Treasury to buy stocks and stock indexes to, the word is manipulation, which is what it is, the markets. So maybe part and parcel of that is going on here as well. So we've seen so much questionable activity on the part of government agencies that, of course, this is legal, but there's no real discussion about that. So I'm convinced that's going on as well. So that continues, we can get a bunch of bad news, a little bit of a shakeout, and then right back up again with all these external forces at work here in the marketplace, and an election next year in the U.S., a lot of political forces going in both directions. So, we could see the worst of news geopolitically. We could see a debt default. We could see rates continue to go up. We could see bank loans tighten and contract business and create all kinds of recession or depression talk, yet the market holds up because of all these other variables. So, you just got to make a decision, are you in or are you out? And we tend to trade more, but I would say at the present time, we're in a little choppy time frame, but we have to watch what happens with this debt ceiling story and the contraction of debt and bank loans, which I think long term is more of a negative for the market, but short term may be ignored by the market.
Do you think if the U.S. was really in danger of running out of money, somebody like Joe Biden would dip into the accounts of billionaires like Bezos, Musk, Gates, and Buffett?
Dip into the accounts in what sense?
Well, seize assets and sell them, or ask for cash from those people, or demand cash. I mean, look at back in the 30s when Roosevelt banned personal possession of gold except for jewelry.
Well, the big guys don't seem to be worried about it. In fact, there's a whole argument that the debt default actually occurred, or you thought it was going to occur, just by Apple Computer, because they're not going to default on their debt. They're making money. Mm-hmm. And they got billions and billions of extra cash floating around. So whether U.S. defaults or not, someone or an entity like an Apple Computer, or you can use other examples like Meta, which is a former Facebook, they got plenty of cash, their stocks are up, they don't have a debt problem or the concern of that, then you put your money there. So I don't think, the big guys are running anywhere other than sticking with their own companies, because particularly the high-tech names, it's their cash cows, and they don't have to worry about, a debt ceiling or the inability to pay bills. It's just the opposite. So honestly, if you just think the U.S. is going to default on its debt just by the cash flow companies, and they're probably these 5 or 10 big high-tech names leading with Apple that have just the opposite situation internally.
What is the real story with gold? As you said, if it was an honest market, it would be a lot more expensive. They say the world doesn't even have the gold that people claim to own. Why isn't it much more expensive?
Well, there is the suppression of gold, which has been going on for decades on the part of governments. And this has been documented for over 20 years by Bill Murphy at GATA.org, GATA.org, have all the anecdotal and real data supporting, in fact, actual prosecutions of big traders at some of the biggest name firms that were convicted of manipulation of the gold and particularly silver markets, but backed by the government on a certain level or on a big level based on all the research they've done. So it's gold suppression. Why? Because it makes the government look bad when gold is up and silver is up, and using futures contracts at the COMEX, hit bids and suppress the price without having the metal behind the contract to really back it, but just a lot of cash to do it has been going on. So big picture, gold should be a lot higher, silver a lot higher, but they've been suppressed. And that's one reason. And on a shorter term basis, we did see a little bit of a breakout in gold. Silver's nowhere near that $50 area. It got to 24 to 26 level. The $50 level was the big high from 10 more years ago, back in 2011. But it was encouraging to see gold up a little bit, but not as much or as strong. And some of the shares haven't broken out to new highs, which is usually what they call a negative divergence. Usually you want to see the gold shares take off before the metal, which most instances did not happen this time. And what's going on with the banks and the credit and all these other things, hurt gold. I mean, when you get a big sell-off in the stock market, they throw the baby out with the bathwater, and you see gold come down because people have to liquidate positions, when they're called on margin or when they need money for other reasons. So gold doesn't always go in the opposite direction of stocks. In many occasions, it does decline when there's a big sell-off. So, gold's been tracking up here with the market in recent months, in terms of just the recovery we've had since last fall. And it could be just a function of, just sentiment, bullish on the markets rather than whether the gold itself is being manipulated or not. But I'm just concerned that, when things really come down and there's more of a bank crisis, which still could happen if more banks fail, and we have, loans failing, and there's still a lot of negative stuff happening out there. The Fed hasn't done its job, and inflation is still high. In fact, I read just recently that in Europe, in Britain, I think the inflation rate's like 10%. So, we're actually low compared to what's going on elsewhere in the world. So the bottom line for gold is you got to trade it. And it broke out just recently, but couldn't stay up there. Now it's pulling back again. I'd like to see a close above 2085 or 2080 in gold rather than just running up as it did, sort of kiss that number and, fall back. and then in which case maybe we could see a stronger move, into that 2,300 or 2,400. Like I say, if the suppression of gold is still going on and the government's still fooling around with it, and I can't give you an exact example today, you question how could ever really go up really big if the government's involved in suppressing the price. On the other hand, maybe they loosen the reins a little bit at this time, or maybe, as I've read, some central banks around the world have decided to buy gold now, and maybe they're breaking off from the scheme of suppressing it, and maybe things are starting to finally change a little bit. I like gold and gold shares, but more in terms of trading them, rather than just putting them away because of the volatility that we've seen. So I don't want to say I'm a bear on gold or anything like that. We just have to sort of trade it, and we have some names in our newsletter we talk about and so forth. But that's the best way I can respond right now. Just it's tradable. Right now it's a little bit of a correction. I don't know if it's going to come down big here or take off and break through, but that breakout level again is at 2070, 2085 area. And of course, everywhere else in the world, my comments are irrelevant, Jim, because, in Canadian dollars and in just about every other currency, gold's already into new all-time highs. So it's really the U.S. dollar and watching the action of the U.S. dollar. If it, has more of a correction, that's going to be, better for gold. And if the U.S. dollar starts taking off here big, for any number of reasons, that would help suppress the price just on the inverse relationship gold and the U.S. dollar tend to have. So I should have mentioned this a minute or so back, because the U.S. dollar is a ingredient in this whole concoction here of where gold is going. So that's sort of the nutshell.
Could the holders of gold increase the price by demanding the delivery of physical gold? If everybody said, no, I just don't want a certificate, I want that brick delivered to my house or my business.
I'm not up to speed on that as much as I should be. There was a period of time where you demanded it, and the COMEX would not be able to deliver it and would have to settle for cash. And I don't know how many holders of contracts are out there that want to demand the delivery can get it or not get it. There was a period of time that was in question, and that was part of the suppression scheme that I had referred to, that a lot of parties were involved with. So I really am not clear on that. My gut feeling is if everybody demanded the physical delivery, from what my understanding is of the nature of the market, it's really not there. And even the government itself, with the leasing of the gold and the government involvement in gold, all the gold that we think is really out there is not really there anymore. It's been either just sold or leased out. So my gut feeling response to the whole thing is the demand for delivery of everything would not be successful, and that could be a big short squeeze and could theoretically drive prices a lot higher. So that's I guess the best answer I can give you. But a lot of shenanigans going on in that market. Tough making a call on the physical delivery side, how much actually could be delivered if they had to. I know when some governments in recent years are looking to take back their gold, and they had to go to the vaults in New York or London, they had to wait to get it. It wasn't like they could get it so fast. It would be paid over a period of time, which sort of raised the red flag. It's probably not really all there, and they got to scramble to go get it. So there is probably a real shortage based on many years of just hearing about what's going on out there, that not all the gold that we think there is really deliverable. So you're probably right, but I don't think everybody's going to jump in on Monday morning and demand their gold, and gold's going to explode. So, and then you got the government itself. What gold the government could do in theory is they want to suppress the price. They just hit the bids on the COMEX and just drive the price down, even though they don't have the gold behind those contracts that they're hitting the bids for. They got a lot deep pockets, and they can continue to play with that market and try to suppress the futures market. And that could do a lot to keep from gold going up, even though some are demanding physical delivery of it. So there's just so many games. It's such a complicated situation, and you really got to read the work of Bill Murphy over at Gata.org and see all the research they've done, and all the shenanigans in the gold market. So I tend to be more of a trader. We made some money with it on this rally, and we'll just sort of keep an eye on it to see where the next trade is.
Yeah, and then there's what I call the real price. If I go down to my local gold and silver coin shop, I'm going to pay a whole lot more for that gold and silver than the official price on the stock exchange.
Usually it's about 5% over the spot price.
Yeah.
Most of the dealers want sometimes more. So you have a loss as soon as you get in, and if you want to sell it, they want to buy it 5% less than the current price. So you've got a 10% spread there, just if you want to play with the market. What you got to do is buy on weakness. Take a longer term view. And the big sell-offs in the gold market, we had that this past year. There was about $300 correction in gold at one point about 3 months ago, and you just buy into the correction. You don't worry about that 5 or 10% spread because you're accumulating into weakness. So that's the best way to take positions. But when it's at a new high, it's at 2015, you start paying 5% over, then you're taking more risks unless you're totally convinced that it's going to 3,000 or something, which could happen. I don't have a crystal ball on that one, but there's been a lot of talk that it's going to happen if we live long enough. So we'll see.
What's your feeling on crude? Is it just going to continue to trade in its current range where it only changes $5-6?
Well, we have a technical chart that sort of helps us out there a little bit because there's some stuff that's sort of interesting out there. There's a 100-day moving average that I sort of track in the crude oil market, and it's sort of tracking below with that. So it's in the mid 70s or high 70s right now, that moving average. So if the most recent newsletter that we have that we published, the one that came out Thursday, if anyone wants to sign up for our VR Platinum letter, you'll see this chart, and it shows you the tracking of the moving average and where the resistance and support is. So far it's in a down channel in between these the zigzags on this moving average, and it hasn't broken out back to the upside. So that would be sort of the key, and we're watching that. My personal opinion is crude oil is going to $200 an ounce, but that could be a 5-year, comment. I think that's one of the reasons. A barrel, sorry. We're talking about so many markets, right? So I think it's one of the reasons Warren Buffett is in there with Occidental Petroleum, and they question why he's doing that, because he's buying, Occidental Petroleum with crude oil around, $70 a barrel, and he probably thinks, as I do, that it's going to be $200 a barrel, and he's got a different time frame than most traders. So 5 years from now, if crude oil is at $200 a barrel, that Occidental Petroleum is going to be worth a lot more money, and they're making money anyway because they seem to be good producers of the product. And he discussed that, by the way. They had a Berkshire Hathaway meeting just a few days ago, and he had a whole discussion about why he owns Occidental, owns 25% of the company, and why he's not going to go take it over, but he still likes it because apparently they're good at what they do. But I think that's one of the reasons he's in there. But getting back to the crude oil on a trading basis, it's still in this little down channel, and some of it has to do with the price of the U.S. dollar, because the crude oil's inversely related to the price of the dollar, and dollar continues to get weaker and weaker. That should help support the price of crude oil, and we're not even talking about Iran confiscating ships in the open in international waters and all the other fun stuff, and we don't know what the Saudis are going to do. Are they going to jack the price of crude oil back up again? And there's war breaks out around the world, what that's going to do to demand. We've got the hurricane season coming up and all kinds of good stuff. But if you're just trading it technically, we seem to be, as I mentioning it 2 or 3 times here already, that we're in this little down channel, and we want to see it break out of that as a trader, and that I think help support and move back up again, probably back up toward 100, and we'll take it from there. But right now, other than owning something like an Occidental Petroleum because you believe in Warren Buffett, there's no glowing reason to own a lot of crude oil at this moment technically, and we'll wait to see how the charts play out.
What's your feeling on Bitcoin? It seems to keep hitting its head on about a $30,000 ceiling, and then it drops again.
Well, when it got down to 15, we were buying it, and not Bitcoin itself, but the Bitcoin Trust, which is tradable on NASDAQ. It had a big move. It doubled. So technically it probably is overbought here. It's going to take a little, time, digest the gains that it had. And you have to be really patient with this market because it seems to run in 2 and 3 year type cycles. So I think it's going a lot higher, but it might be 3 years from now, and it might drop back to 20,000 before it goes to 40,000. So one way to play it is owning this ETF type vehicle, or you just wait for another shakeout and see if you can get buy a little cheaper. So my best reading of it is it hit a little resistance here, and it trades sort of with the stock market too. When the market becomes more speculative, the Bitcoin seems to rally along with the market. The fact it topped out here might be a sign that the market, for the same reasons we discussed earlier, with all the stuff going on with the Fed and with the debt ceiling and all this other stuff, that it just got overdone. It just needs to digest itself a little bit. But, there's some people who just believe, in fact, going back to Warren Buffett, because I remember hearing that at his presentation, or it was Charlie Munger, his partner. Basically their view is, cryptos are going to zero. They're all worthless. So everybody's got their point of view about it. I sort of feel they're a hedge against currency and government, and that's why they were created to begin with, to be outside the system. And whether government could shut them down at some point, governments already tried to and have been unsuccessful or changed their minds, as was the case of China a couple of years ago. I don't know if they're going to, government's going to come in with its own cryptocurrency, its own digital currency, which seems to be in the works. You can wake up some Monday morning and all your money in your bank is not cash anymore. It's some digital currency that you have to use, and how that's going to affect the other cryptos. Government's going to say, well, we got our own now. Everything else is illegal. I mean, can they really do that? Will they really do it? I mean, there's free markets around the world that'll continue to trade. They say they try to ban cash and say nobody can use cash. You think cash is going to disappear? No. There'll be a black market for cash, So, I mean, during the Prohibition, you could still get alcohol. You know what I mean? When FDR banned gold in the 1930s, there was still gold around, So government can only do so much. And that's good because government controls too much to begin with.
Now, we'll close off the show with a study that finds financial influencers who are the loudest and have the least amount of experience get the most attention. Is that counterintuitive?
Oh, they're going to get me into trouble on this. I mean, I think a lot of it has to do with entertainment and information. I mean, going back into the 1980s, Joe Granville was very vocal. Many people don't even know who he was, but he was one of the leading technical analysts. He would move markets by making some proclamation. When I saw him in person decades ago, he'd play piano on the stage and entertain everybody, and your mouth was hanging open with his prognostications. And I don't want to say he was good or bad, but he did influence the markets. And today we have someone like Jim Cramer on CNBC, and you can't say this guy is not entertaining you. I mean, it was even more pronounced a few years ago where he really was wild, with a lot of stuff. He's calmed down a little bit, but it's, all the noises he makes on the air and the machine that makes funny sounds, and, it's like a circus. So is he a clown, and is he real, or is Joe Granville the same or not? And I guess you can pick and choose that some things they say work out and some don't. So for me, it's more entertaining and providing information, which gets you in front of the spotlight on Wall Street. And those two, key names out there that have been very notable and successful over the years in getting the word out about what they believe in the markets and so forth. But I know, they're trying to sell airtime too. Commercials. You get somebody real entertaining in front of the camera who can talk stocks and bring, advertising dollars into the TV station, radio station, network. They're going to try to, benefit from that. So that's sort of my best reaction to your question. I hope I addressed it.
Mark, before we go, can you remind our listeners again about the special offer?
Yes, sure. So if you go to vrtrader.com, that's VictorRobertTrader.com, use the promo code 2022 half off, and you get 50% off of any of our newsletters or group of newsletters for any time frame you sign up. Again, 2022 half off at vrtrader.com. Thank you.
Mark, thank you so much for being on This Week in Money.
Oh, it's been fun. Thanks, Jim.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He was speaking to us from Arizona. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Mark Leibovit, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. And we have links to Eric Haddick's charts to the drought and flood cycles below the player. They also include gold and silver and bonds. Now stand by for a company showcase update from RecycLiCo CEO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. My guest is Zarko Meseldzija, Chief Executive Officer of RecycLiCo. Welcome back to Company Showcase.
Thanks for having me, Jim.
Zarko, what's the latest in the big office there?
Well, Jim, there's a lot to discuss today, and I do understand the curiosity from an outside the company vantage point, but that's also exactly why we communicate via podcasts such as these, press releases, and social media to really keep all of our listeners informed as much as possible without violating any confidentiality agreements or disclosure policies. In the past, on the press release side, in the past, I would say, we did have more frequent press releases, and I would say that's really throughout our technology research and development. And, that was on our reporting as we progressed. And even in the past year, we have continued to do so with achievements such as, our environmental impact report, our demonstration plant commissioning and testing, the high quality material production such as lithium and cathode precursor we've produced. And not only that, but also the use of those materials by other companies to make battery cells that achieve equivalent performance to commercial materials. But given all of those, technical success and testing, management is now taking our current scale-up ready stage and more focusing on establishing, multiple joint venture relationships, like I've explained in our business model. And on another point, regarding Sonnet, as many listeners know, we have announced the signing of an MOU with Sonnet in January of this year. And as we stated, the MOU represents steps towards potential commercial joint venture and an outline of potential strategic partnership and the business framework. So part of these steps are many hours of evaluation regarding technical and business parameters that require a team of people to come to a win-win agreement that is in the best interest of the shareholders of each company involved. And any material change updates will come from RecycLiCo directly as well. But this also brings me to the financial forecast model, which I've also been getting a lot of questions on recently. RecycLiCo, of course, has a detailed financial forecast model that does take into consideration multiple scenarios and price sensitivities. And the model is part of the evaluation material in all of our confidential discussions. And also the way this model comes together is from all the testing we've done, from understanding the chemical consumption requirements, the electrical requirements. So this is what brings this model together. And although we believe it is our competitive advantage, the models are a competitive advantage, we don't believe it is prudent to share the model publicly, because our business model aims to establish multiple bespoke joint ventures around the world. Therefore, depending on the specific scenario, such as the plant location, the size of the plant, like the process capacity, the labor or wages, and the material pricing, all of those will, the potential joint venture outcomes would differ. So I hope that does make it clear, right? And I think we're moving forward, and as we've explained before, and the products we produce, right, even from just looking at the value of the products we produce, where it's precursor material and lithium hydroxide relative to the value of black mass or the individual metal salt, right? If you just look at that incremental gain by being able to upcycle to the higher value material, that's just an important reference as well, if you're looking into it. But we believe we are taking all of the appropriate and methodical steps towards the overall success of our technology and business model. And as we've shown in our technology scale up, for example, we've gone from lab scale to pilot scale to now the demonstration plant, which along the way has de-risked and positioned us to more effectively execute on the commercial scale. Like I said, all of this data has also helped develop the financial forecast model we use as well. It's also key and for that instance, it's also key when it comes to budgeting future projects and our company runway. I've researched and seen it far too many times where a company scales technology too much and too fast without recognizing the consequences on an engineering and cost level at that different scale. And, even in the battery recycling industry, from what I'm seeing recently without, naming specific names, I'm reading about projects with cost overruns, that I believe will inevitably end up hurting their investors. And, even coming from our former CEO, Larry Ray, right, he would always say that you can never get away with cutting corners because, in an attempt to take 2 steps forward, you end up falling 5 steps back. So I think he was really great at drowning out the noise and focusing on the fundamentals of the business and technology.
Zarko, for people new to RecycLiCo, what does the company do and how can they get more information about it?
Yeah, RecycLiCo is a battery materials company focused on developing innovative recycling and upcycling technology for lithium-ion battery waste. You can get more information on us at our website at www.RecycLiCo.com. And we are a publicly traded company on the TSXV under the ticker symbol AMY, on the OTCQB under AMYZF, and the Frankfurt Stock Exchange under ID4.
Zarko, thank you so much for the update.
Thanks, Jim.
My guest has been Zarko Meseldzija, Chief Executive Officer of RecycLiCo. Our conversation took place on May 12th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.